Good morning, everyone. My name is Tom Lyons. I'm the host of today's Business Radio. I'd like to welcome you to Town Hall at News Talk AM 1130 this morning. As you know, today's Business Radio has a series of vignettes that play on Twin Cities News Talk AM 1130 every day at 11:59 a.m. And we have a number of sponsors in there that help business owners try to build enterprise value and improve their businesses. And one of our sponsors is Venture Bank. And this morning we're going to talk to some folks about a venture bank topic about effectively managing your cash flow because it's a crucial component of the success of your business. And we have three panel members here today that are going to help us with this, and we'd like to have them introduce themselves now. First is from Venture Bank is Jeff Bajek.
Good morning. I'm Jeff Bajek. I'm with Venture Bank. I currently manage the credit department at the bank, which really is a function of underwriting and evaluating businesses for credit quality, as well as some of the regulatory requirements on the bank. I've been in the banking business about 18 years, working primarily for community banks in town here. And Venture Bank, we're about $350 million in assets, small community bank. We really like to help small businesses kind of succeed and provide them with the working capital that they need to be a profitable company as well. But excited to be part of the panel.
And second, we have Terry Shepard, who is not with Venture Bank, but works closely with them. Terry?
Good morning. I'm Terry Shepard with Exact Resources. We are a full-service collection agency here in Minnesota, located in Burnsville. We do consumer collections and commercial collections, and we work with a lot of small businesses to help them increase their receivable collections, do reminder calls, and help them understand and do training on how to better collect on their aged receivables. So, well, thank you.
And next with Venture Bank is Stephanie Hansen.
Good morning, I'm glad to be here. I am Vice President and Head of Cash Management at Venture Bank. I've been at Venture Bank since day one when we had 8 employees, and now I think we have 70. Like Jeff said, we focus on small business, and despite what you might hear in the media, we are very interested in lending. We increased our lending last year by about 27%, which is a fabulous year for us. My focus on the cash management area, there's been all kinds of changes in technology on the cash management side of things, which keeps my job really interesting and fun. I like to help small businesses understand how their business works and find the appropriate tools for them to help them collect their cash as fast as possible and then hold on to that cash for as long as possible. And I'm glad to be here today.
Thanks, Stephanie. As if any of you have heard us on the radio at noon, and I hope you all hear us every day at 11:59. And by the way, we're going to have an exciting announcement about that program coming up in the next few weeks. So if you filled out the registration form, we'll be sending you some information about some changes to today's business radio that we think are going to help you and help us. But if you listen to our vignettes every day, we always include this disclaimer, and I've been asked to read this morning. This content provided today is for general information only and should not be treated as a substitute for professional advice from your legal, accounting, and business advisors. We're going to cover some things this morning about managing your cash flow and about collections and so forth, but these are examples of how to do it. If you have issues within your business, please consult with your legal experts and make sure that you're doing things correctly. Or, of course, come to the bank and talk to Mr. Zink and his folks, and they'll be glad to help you out. First off, Terry, I want to start with you. How should accounts receivable be reviewed, and how should a business rate them on risk?
All right off the bat, 8 a.m., are you all thinking about your receivables back at the business? Okay, wrap your mind around that for a couple minutes here. Generally, what we find is it's one of the last things that a business owner thinks about, but it ought to be one of the first things that you think about because it is cash and it is what is going to drive your business. So one of the things that we do see when we work with business owners is that they treat their accounts receivable all the same. So they believe that past due statement might get that payment made by just maybe stamping past due on that statement and mailing it out every month. And obviously, those of you that have a small business and do extend credit, you probably know that isn't working or hasn't worked, or there are times where it isn't working. So I do recommend that you rate your receivables, and depends on what you've got out in your book of receivables. But don't treat them all the same. Take a look at what the receivables are and look at your risk level on each of them. It might be a high balance account, and you might want to put different processes and procedures in for that. Or it might be a new relationship, and you might have a little bit of a question about that company. You maybe extended a little bit more credit than your comfort level was. Put them on high alert and be right in their face, and don't put them in your regular routine of working on the receivables. The other thing is to have your employees or your salespeople hear what's going on the street. And a lot of times they'll be the first ones that might hear about a customer. If you start hearing things on the street about that customer, maybe another vendor, their payments are getting delayed, or there's things that they're hearing, be aware of that and maybe put that customer on high alert, and maybe make a reminder call before the due date, before the invoice is due, or shorten your terms, or higher down payments, or things like that. So
Terry,
just keep it top of mind.
Just a follow-up question to that. We have, hopefully a lot of small businesses here, and my business is like theirs. We work so hard to sell our product or services, and we're developing relationships with our customers. And then once you've sold them those products or services, now you bill it out and you've got an accounts receivable. How do you balance that cycle of we're selling and now we have to collect? How do you deal with those customers so as not to alienate them, but to keep them coming back for your product and services while you're dealing with your receivables, which have been tough the last few years?
Well, my answer to that, Tom, is that you never have your salesperson collect on your receivables. The worst person, if you want your receivables to be collected, don't let that salesperson collect them. Let the salesperson have that relationship and build that relationship so you do get residual business, but have a bad guy in the office or somebody else make those calls. They can still be positive calls, but they can be that squeaky wheel. And have someone else do it. Maybe it's somebody's college student or somebody else in the organization is a much better person that can be a little bit more diligent about calling on those receivables.
Terry, can you coach that bad guy in how to be effective but gentle?
Oh, absolutely.
And that's part of what you do.
Yes.
All right. Jeff, what are the various ways a bank evaluates cash flow when making credit decisions?
I think the first thing business owners, I think they understand it, but the thing to reiterate is bank debt gets repaid from cash flow, despite some people's beliefs that collateral can repay the debt. Our objective is to get repaid from cash flow out of the business that's generated. Our first approach to understanding what cash flow works, evaluating the cash flow, is through financial statements. Business owners should really focus in on putting together good quality financial statements that a bank can understand, that a bank can rely on, and the bank can evaluate. We take a financial statement in and break it apart and try to determine what is getting converted to cash. A lot of times a business owner will take a look at the income statement and focus slowly in on a debt service coverage ratio, your EBITDA starting point, and then saying I've got enough EBITDA to focus in on paying the debt service on my debt obligations. But the piece that I sometimes wonder if business owners miss is the balance sheet side of that cash flow statement. The balance sheet is a big component of cash flow and what gets converted. Your receivables start as a paper invoice, and ultimately you convert that to cash. Your inventory ultimately gets converted into cash. There's other areas of the balance sheet that eats up cash. Your accruals and payables and things like that. You have to focus in on the balance sheet as well as the income statement, and that's what we tend to look at. I have a really good example of a business that I worked on probably 12 or 13 years ago. It was a lumber company that a community bank I worked at financed. They moved into a brand new large facility in town here, and they were a small lumber company, and they proceeded to fill up their lumber yard with inventory. Well, what they did is they ate up all of their cash that they had. They couldn't convert convert the lumber into a cash flow perspective, and they basically ran themselves into the ground because they couldn't pay their debt obligations. They were still profitable, but all of their cash was tied up in lumber that couldn't be converted easily. So those are the things. The balance sheet tends to be a big focus from at least my perspective and a lot of the bank's perspectives on understanding what cash flow will deal with. The other thing we like to look at is projections. It's difficult for a small business always to sit down and put together a good set of projections. They're very busy. They're focused in on selling their product, trying to generate revenues. But if you're looking for bank financing, you're looking to grow your business, understanding what the future looks like and how the cash flow is going to get impacted on a monthly basis or an annual basis. So a good set of projections is very helpful for a bank to understand whether or not understand the business's cash flow needs. And the thing with projections is, we kind of want to have realistic projections. The concept of sometimes what I phrase field of dreams projections, where you put them together. It's very you're very excited about them. You really think you can achieve those projections, but they're not realistic. Make sure they're realistic. Understand how you're going to grow your business and how you're going to achieve that. Are you taking market share away from somebody else? Are you simply growing organically? Are you going to do expansion? Understand how all those components fit, and then be able to explain them in your projections that you provide to the bank. Putting together a good set of assumptions is very important with projections on that. So those are kind of the general ideas that we look at to evaluate the cash flow at a bank level. The other important piece is we also look at deposit activity within the accounts. If we see a business that is reporting profitability on a consistent basis, but they're consistently overdrawn in their accounts, we can have a good understanding that they probably have some collection problems on receivables. They may be having their cash tied up in inventory, and we can try to then back into to understand what's going on. So evaluating the financial statements and then keeping an eye on deposit accounts, which is one of the reasons our bank and a lot of banks really rely or really expect a business to bank with us fully, deposit accounts and loans, because we want to try to help you guys and help businesses succeed by keeping an eye on your deposit accounts to make sure that your cash flow is being managed appropriately.
So Jeff, when you're evaluating a business as a banking customer, you're going to look at historical cash flow, projected cash flow, aging on the accounts receivable, but then you also take a look at the balance sheet and try to get a balance between debt and equity.
Yeah, absolutely. Cash flow is important. The debt and equity piece is another very important piece of our evaluation. I always look at equity in a company as your cushion, especially during the last recession. A lot of companies that had very little equity in their company really struggled and may have not made it. But companies that had good, solid equity positions survived some of the recession that we just went through. And equity can get stripped out via net losses or distributions to business owners. Our bank does not want to control necessarily how a business operates, but we want to make sure that you keep enough equity in there and not distribute significant amounts of cash out to keep that cushion in there, which ultimately impacts your cash flow as well. So the debt to equity piece is an important part.
Just the last follow-up, it's very important for the business customer and the banker to be partners and be open and talk frequently so that you can show them or help them with problems and before problems become insurmountable.
Yeah, absolutely. The relationship between the banker and the customer is very crucial. You have to communicate with your banker to explain what's going on, the good, the bad, and the ugly. And business owners that come to a bank and lay out their needs, their challenges that they're being faced with is extremely important, because then we can try to find a solution to help you get through maybe a challenge you're being faced with in your industry or your company in particular. So we love to hear about the good things, the successes, the profits that the companies are making, but we also want to know if there's a problem with cash flow, with collections. We can put you in touch with Terry, maybe she can help you with collections. We can point you in other directions. Stephanie could help you with your cash flow, maybe through cash management products, et cetera. So communication is extremely important because we can only learn so much from a balance sheet and income statement. because we're spending time making assumptions by looking at numbers. But when you explain the numbers to your banker, it becomes much more clear in how things are working along both the balance sheet and the income statement.
Tom? Thanks.
Can I ask a question?
Go ahead, Rob.
Jeff, with regard to the communication process, and specifically on the issue of the projections, what's the level of comfort that the bank has with regard to the amount of detail that goes into that, and the strategic plan that goes into the thought of where the projection comes from? And number two, what's an acceptable margin of error in terms of where we're going? Because I'm sure there is one of those.
Yeah, the projections and the detail in the projections, the more the better. We certainly understand and respect the fact that the more sophisticated the projections become, the more likely you have to put in a professional, a third party involved, maybe an accountant, to help you put them together. And there's a cost to do it. So we are respectful of that, and we understand that. So if you're not in a position to hire someone to help you with those projections, we understand the detail may not be as extensive as we would like it to be. But the more detail, the better. Understanding, I think the keys with projections is explaining how you're going to get to where you're going to get in the projections. Saying that you're going to grow your business by 20% is great, but how are you going to get there? What's going to happen with your margins? Explaining that relationship in the projections, I think, is really important. If I look at projections and they're a 20% growth, I want to know why. How is that going to happen? Where are you going to get that growth? And so putting together a quality set of assumptions, I think, is more important than getting down to every detailed account on expenses and on the income statement. I'd rather see a very robust set of assumptions on your projections. In terms of the kind of the margin of error on the projections, at our bank, we tend to look historically at the projections and how the company achieved those projections on a historical basis. But going forward, we tend to like to see projections, the company perform what we say substantially on projections. So 5 or 10% differential in it, I would say that's pretty substantially on projections. If you start exceeding a 10%, then I think there's some questions whether or not your projections are useful or can be relied upon for that particular year.
Thank you. Stephanie, we're coming to you, but another question, sir?
Neil Dog, a question I have for you. Do you like seeing a sensitivity analysis once you get the so-called, as I call it, the book of either, I'm a consultant. I don't think a good consultant, there is no cost to a consultant. They should prove themselves. The question I have, do you like to see a sensitivity analysis to the projections where you have so-called totally achievable and a stretch, or do you don't want to see that?
No, what I really want to see is realistic projections. What do you really think can achieve it for that particular year? I do enjoy looking at the projections on kind of a home run year and a year in which some unforeseen risks kind of occur. I like to look at all those, but the most important one is what's your realistic expectations for the year. And that's the most important because that's what we're going to rely on. And we'd love to see a home run year, a stretch year where you're going to hit the ball out of the park and really maximize your margins. But at the end of the day,
how about on a historical basis, say 11 against actual versus budget versus last year? Is that helpful to you?
yeah, like I said, we do look at how the company performed historically as compared to projections. We do assess that because that gives us an opinion on how much we can rely on the projections going forward. If every year they're significantly off, then we know something's not getting done to the best of its ability on the projections on a year-by-year basis. And then the other point about your sensitivity analysis, yeah, we would love to see sensitivity analysis. I mean, there's all kinds of approaches you can take on interest rate sensitivity. If you're a business that has a lot of commodity exposures in the metals and the food industry, what happens if your prices increase by a certain percentage? Can you pass it on to a customer? How is that all gonna work out? So that would be great. We don't quite honestly see a lot of that in our small businesses because they don't have the time. It's difficult to put those together, and we certainly do understand that.
Thanks, Jeff. If anybody wants that 20% growth, it's hard to deal with. Just talk to these two gentlemen from Twin Cities News Talk AM 1130. They think they can help you with that. Stephanie, every time I see you, I learn about some new services as a business bank at Venture Bank. And I know that you've got some things that you can do to help businesses with their collection process. Can you tell us about that?
We do. When you talk about methods for making deposits at banks, you know, obviously the most traditional is you walk into the bank and make your deposit, which would probably mean that you have to get in your car and go to the bank. You can mail your deposits to the bank, but the two fastest forms of getting your deposits to the bank are either lockbox services or remote deposit, which is also known as remote capture. They're quite different. A lockbox service, it's been around for a long time. It basically allows you to outsource your deposit process to the bank. And this is how it works. You have your customers remit their payments to the bank's post office box. We have a courier that picks up those deposits at the Minneapolis post office first thing in the morning, delivers them to our Golden Valley office, and, where we sort those items and deposit them to your account on the day that they're received. We then supply you and whichever employees at your office that you want to have that information. We deliver a report called a remitter report that details who paid you, what was the amount of the check, what invoice number was it paying, or was it paying multiple invoices, and we send that report to you electronically through your online banking. It allows you to post those payments on the same day that they're received. It allows you to get credit for those deposits on the day that they arrive in the mail. So essentially you save 1 day's worth of time if you get that deposit in the mail to the bank versus using a lockbox service. We can take that a step farther, and we do have customers that do this. Rather than just sending a sort of a plain vanilla remitter report that comes in a PDF format, we can actually put that data about who paid you, the amount that was of the payment, the check number, the invoice information. We can actually put that into a CSV file format and deliver that to you. Work with your accounts receivable accounting package, your software provider, to figure out how to import that directly into your software, which if you have a number of payments can save quite a bit of time. And every small business is looking for efficiencies, so we can work with you to tailor a solution like that that works. We have some customers that use it and love it. The other service, and it's newer, although it's been around for a while. If you recall, in September of 2001, we had a tragic incident in the United States where airline traffic came to a halt, and we were not able to move banks around, physical checks around in the system. And so by 2004, Check 21 was passed, and what Check 21 did was to say that the electronic copy of a check is the legal equivalent of the check itself. And that allowed banks to begin taking images of the front and the back of items that you sent to the bank for deposit, and we delivered those items electronically to the Federal Reserve. And so those images of the checks now travel around within the banking system. Shortly after that, we decided to roll that product out to our customers in the form of remote deposit. And what is remote deposit? It's just a way for you to get your deposits to the bank without ever leaving your office. Essentially, you have a specialized check scanner that scans the front and the back of the check and collects an image of the check, and specialized software that's either something that you load on your computer or an internet-based solution, where you essentially scan images of your items that you're collecting and send those deposits to the bank for processing. The beauty of remote deposit is you can use it any time of day. It's just like walking a check into the bank and handing it to the teller in terms of funds availability. You can make deposits as often as you want during the day, so it works great for companies that have business-to-business type transactions where payments are coming in via the mail. When those come in, you scan your items for the deposit, and then you post them to your accounts receivable system. But if you've got salespeople that are out making calls and happen to collect some checks while they're out, they can bring those in too. You can deposit as often as you want all day long.
So speed up the collection of the receivables and
Yeah.
manage your payables and help your cash flow.
Absolutely, absolutely.
Stephanie, what's the cost?
I'll go ahead and get it. There's a flat fee for remote deposit. If you if you are key entering the amount of the checks, so if you have a small number of checks that you're doing, it's just a flat $65 a month, you actually get a little bit of a per item discount on the items that you deposit. So our regular charge would be 12 cents an item. You actually get a 2-cent break on your items that you deposit remotely, so they're 10 cents a piece since you do some of the work.
Thanks, Stephanie.
Mhm.
We're happy to take your questions, so if you have any while we're going, just raise your hand and we'll come to you as soon as we can. Terry, I want to know you want to talk about daily sales outstanding. Why is it important to calculate that number?
Yes, that's exactly what I want to talk about. Thank you. How many of you know what DSO means? Besides the accountants in the room, you don't count, you don't get to vote. Daily sales outstanding is one of the things that Jeff is going to be looking for when he's looking at your financials every month. And it's something that is measurable, that you can measure, and it's also something that you can work on improving in your business. So it's taking a calculation of how much you have in aged receivables divided by your average days that are aging. And that's a number that you can be tracking, and there's not a perfect number because it's by industry standard, so it just depends on what industry you're in. But there are industry standard numbers that you can find online, but it is a number that you can at least measure and hold people accountable to improving that by using cash deposits, lockbox. There's a lot of ways that you can work on improving that number. But I just like for everyone to be aware that there is a way of measuring that, and if you're not, you ought to be.
Jeff, just to follow up on that, Terry says that you look for that number, daily sales outstanding. When we're talking about financial statements, can you talk to us about how important it is to have accurate financial statements, and how often do you need just year end? Do you need quarterly? Tell us about that.
Yeah, the financial statements are, again, we talked about it, that's our key tool at a bank to monitor and keep an eye on the company's performance going forward. Most banks, including ours, we measure financial reporting generally in two approaches. There's your typical revolving line of credit, which companies will use to manage their daily working capital, or utilize for their timing issues between collection of receivables and payment of payables and expenses. When you're dealing with a revolving line of credit, generally speaking, you're going to be required to submit monthly financial statements to the bank, an accounts receivable aging report, and a borrowing base certificate. And the borrowing base certificate is a report that a bank will give you an advance rate on your receivables. Our bank generally gives you 80% advance on qualified receivables. And then also there's advance rates on inventory if the bank elects to advance on those as well. And the borrowing base certificate will plug in all the numbers and kind of tell you what your borrowing capacity will be. So if we give you a $500,000 revolving line of credit, generally it's not, here's a $500,000, it's $500,000 subject to your availability on your accounts receivable, because that's our collateral at the end of the day that we can rely upon. So the monthly financial statements are pretty typical for revolving lines of credit. Now, when you're dealing with a $50,000 revolving line of credit, you're not going to have that type of reporting generally. It's going to be a lot less. The other financial reporting measurements start occurring are your year-end financial statements. Most companies do their company prepared. Everybody does a tax return. Those are expectations. But as the level of debt increases, banks start expecting a better quality financial statement. You move into a compilation, you move into a reviewed, and then you can move into a actual full-blown audit. Full-blown audits, large lines of credits, high risk to the bank that we feel we need to have a third party go in, put together some good financial statements that we can rely upon. So that's going to be more tiered based on the level of debt that you have with the bank, as well as some other risk factors that we may look at that we want to get an accountant in there. But company prepared statements, we want them to be as reliable as possible. We do start looking at certain points, your sophistication in your management team. What kind of bookkeeper do you have? Do you have a CFO in the company that's good qualified to put together these financial statements? One of the key factors that we look at for problems in a company is when the financial reporting starts becoming late, delinquent, that's required. That's kind of an early warning sign that something else is going on in the company that we need to investigate a little bit further. It may be that the business is just growing so much that they're getting behind on their financials, but when they start getting behind on financials, then they're starting to lose their eye on other pieces of the business that the business owner should be paying attention to. So timely and accurate reporting are good measurement tools for the bank.
Jeff, what's the definition of qualified receivable that qualifies for the 80%?
The definition could be pretty broad depending on the industry that you're in. But a qualified receivable would be a receivable that's generally under 90 days aged, generally without a company that's bankrupt. When you start getting involved in progress billings, there's issues of advance rates on progress billings, and those are obviously industries like construction companies where you're getting paid based on the progress that you go along. Retention receivables, so these are more, again, contractor receivables where you're advancing against a retention that they hold back to make sure the project's good. Generally, we don't advance on foreign receivables, are excluded as well. Contra type accounts, intercompany receivables. We have a pretty big list that we think about, but we do advance on retentions, we do advance on progress billings. So there are certain cases we do advance on some foreign receivables. We do have programs out there that we can advance on foreign receivables and get other credit enhancements. The bank can get protected on those. So those are general kind of qualifications, but we do advance on all kinds of types.
Stephanie, I want to come back to you a little bit more about do we have a question? Go ahead.
As a rule of thumb, what would be the debt limit before you would have a business go from let's say, a reviewed audit to a full-blown audit?
Generally, we're going to be looking at probably the $3 million of debt range. Again, and that depends on the type of company that you're operating under. There are certain industries that we may want to have an audit regardless if you're at kind of the $2 to $3 million range. But generally, $3 million I think is probably the good number to think about.
Stephanie?
Mm-hmm.
I want to go back to Venture Bank. As I said, every time I talk to you, I learn about more services you have available for businesses. How does a business know which solution's best for them? You sit down and interview them and find out about them?
Pretty
How
much,
does this
pretty
work?
much. That's the fun part. It really depends on the business. Lockbox is a good solution for a company that is looking to outsource, so maybe they don't have somebody or they don't want to hire somebody to take care of that deposit process. It could be a good solution for a company that's growing rapidly and the volume of payments is increasing and they don't want to hire additional staff quite yet. I'll give you a couple examples of where Lockbox has been very successful for a couple customers at Venture Bank. One was a nonprofit healthcare organization. They're always short-staffed, it seems like, because they're got budget limitations. But they actually, as a matter of control, didn't want those payments coming in the door. There were some HIPAA requirements and things. And so they asked for a Lockbox solution, and we actually came up with a solution where we tailored it a little bit, which we're famous for at Venture Bank. We kind of get to know your business, and then we kind of tweak it a little bit. Well, what if we did this, and maybe we could deliver it this way? So in this case, the customer received large payments from Blue Cross Blue Shield or Medicare or third-party payers, but they were large checks for multiple patients' payments, and they needed to know how to post those payments. So we set them up with a Lockbox solution, and we not only delivered them that basic report, but we also scanned all those third-party payer documents that came with the payment, delivered those electronically, so all those papers never came into their office. Only the information they needed to post those payments came in. Not only that, but the payments were made on the day that they were arrived at the bank, as opposed